Okay, welcome back everyone. It's been about a week since I put a video out. I just got back from vacation last night. A little tired today, but we're get right back into the market, and I'll be doing my daily videos, and we'll be back at it with the trade ideas for the private member group, as well as market analysis. Okay, so here's the thing. We do have the Fed coming out on Wednesday. I don't expect big moves, anything major to happen. I think there's probably going to be some small little day trading opportunities. In the private member group today, I shorted the triple Qs twice at 279.50, and it ended up being about 1.5% gain on those shorts. I closed those out by the end of the day, and I'm pretty much flat. So that's how I'm treating it into the Fed. I don't want to take any huge positions, especially market direction positions where we have mixed signals. And the Fed's on Wednesday. So where the market goes after that will be very telling. And I'm going to kind of point out where I think we'll go. I mean, the last time I put out a video, I did the video when I left on Friday the 21st, and you can see that we haven't really gone anywhere since then, at least on triple Qs. I mean, we had this big candle here. They kind of ramped it up, rallied it up to this 285 area. We've been chopping around. I mean, we're only from that Friday point, we're only, 0.9%. So pretty much not a lot's happened, which makes sense. Even though we've had the FANG earnings come out, we still have the Fed. And this market has been trading on the Fed for years. And in fact, I've talked about how I think the market pretty much only trades on the Fed, at least for the last many years. The market's only cared about the Fed. It has nothing to do with earnings. I mean, earnings will get you like a little one-day spike or a little bit of a trend or a swing trade or something, but it's all about the Fed. Does the market get free and easy money, or does it not get it? All right, and that's really what this market's been trading on. So let's go down to the technicals and look at what I'm seeing as of today. All right, well, we're going to start off. Well, let's start off with the weekly chart because I haven't looked at that one for a while. So here's the weekly. We topped out on triple Qs back in really it topped out in November of 2021. Nobody realized that was the top, but that was. I got short back in January, early January, and when we broke this trend line, and sure enough, it's been a downtrend ever since. So make no mistake, this is a downtrend and nothing has changed. We are trending down. So bigger picture, we want to sell the rips. We want to sell key points of resistance until we see a change in this downtrend. And I have not seen any indication in the market that we have bottomed. I haven't seen any kind of panic selling. It's been a pretty orderly move down, kind of going down in waves. So I don't think we've hit the bottom yet. And so I'm still looking to sell the rip or sell rallies into key levels of resistance. Right now on triple Qs, big resistance up here at about 305, 306 on the weekly chart. That's your downtrend line, okay? So then we want to align that with some, horizontal points of resistance. So we'll go down to the daily chart here. And there you go, up here. So big resistance, it looks like, obviously that trend line, but it might line up with something like this. You got a key level of resistance right there at about, that's about 314, 315. So you could run up, hit that, overshoot it, hit that level of resistance and then fail. Or we never even get that high. And the point is, I'm kind of leaning that we don't actually get up to this trend line. We've had 3 tags of the trend line, 1, 2, 3. I think, I think we can probably rally up to this 291.50 area, but I'm not so sure we're going to actually get up to the trend line. Now that's just me going, with kind of my gut on this, but what I would really think, the way I'm leaning towards is maybe we rally after the Fed a little bit, but I still think we've got that kind of that crash price action, that downward price action where we crash down to about 238.50. That's still a target, still remains. I do believe we are going to hit that target. I haven't seen any indication that we're not going to hit that target. It's just a matter of when do we hit that target. Okay, where we're at right now, we are making an uptrend on the daily chart. We're trending up in the short term, and we could continue to trend. We got resistance at 291.50, and we could continue to trend and maybe hit the trend line. All right, so that is a possibility. If we don't do that, we're going to look for breaks of this short-term trend line, and that will be kind of the first indication that we're bearish. And then you take out those lows, those recent lows. Anything down near the recent lows, or potentially, this was your former low here at 269.50. That was your June low, and then we had lots of reactions. They battled it out, undercut it, but recovered it. You take that out again, and it's probably going to be lights out, and you're going to get a swift move down to our final target. That's kind of the way I'm leaning right now, but we've got the Fed on Wednesday. We need to see what happens after that. When I go down to the hourly chart, you'll see that we basically, here's your uptrend. All right, let me kind of clear this out, but we're just kind of walking up this trend line here. All right, and that's still intact. We have not broken that. We don't have a sell signal. So at the end of the day, any kind of short little trades I take are just working in pretty short little, a pretty small little range. Okay, now after the Fed, if we see this break and start to hold, then we could be taking out this trend line and starting that move lower. You'll know it when you see it. It should be pretty impulsive selling. And don't take the first reaction that you get right after the Fed comes out. Usually you want to see how the market takes that first reaction and what it does with it. Does it build on the first reaction, or does it reverse it? That'll be kind of our signs. All right, so until then, we're in an uptrend right here on the short term. We need to see this break to get taken out. We don't have any negative divergence on the hourly. You see we were trending lower here on the hourly, but price is going lower. So we can just continue to kind of move higher and until I see a break of this trend line. I'm not really interested in taking any kind of longer term short. And that's it, And again, I've talked about the upside, the potential for that rally. I've pointed out kind of the downturn levels, and we've got the trend line to watch for breakdowns or sell signals. Maybe we get a spike high after the Fed and it puts in a divergent high and then fails. That's a possibility. We need to see how the charts shape up after the Fed. Okay, first solar. So I talked about this one on... I threw this out in the private member group, I think, last week as a potential short. I mean, it looked like a good short at the time. Doesn't look so much as a good short today. I pointed out what I saw today, but let me kind of reiterate what we have going on. So on the daily chart, all right, this one, you've got a trend line to watch right here. You can see resistance, 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 and sure enough today, they spiked it up over that former high. All right, I don't think there was any news or anything, catalyst, but they spiked it up over the former high. This high on the daily chart is still a divergent high. All right, we are making a divergent high on the daily chart. You can see if I just kind of mark this down like this, you can see lower high in momentum and a higher high in price. So likelihood this is going to fail on the bigger picture, but it might hold up here for a couple days. And here's the reason why I think it could hold up here for a couple days, at least into the Fed, I would think. Going on the hourly chart, you can see there's your spike higher. And we don't have any negative divergence right now on the hourly. So you'll see here, we had it previously, but they kind of took it out right there. So higher high in momentum on the hourly tells me that, okay, this isn't ready to roll over quite yet. So we'll probably hold up here into the Fed, maybe continue to kind of grind higher. Put in some negative divergence, most likely ahead of the Fed, and then maybe we could see this thing break down after the Fed. But yeah, not my favorite with the move today. I got out of the small position that I had first thing in the morning when I saw it started to ramp. I just got out because the bottom line is I don't want to take any big positions, and I don't need to hold on to a position right ahead of the Fed. This one, with taking out the divergence on the hourly, tells me that maybe it wants to kind of grind higher or do another spike high before rolling over. Bigger picture, that divergence is still there on the daily. It's not confirmed, though. So if this is pointed straight up and they just continue to spike it, we're going to take out the divergences. And if you do that, you take out the divergences and make a new high in momentum. So it'll look maybe something like that. higher than the previous highs, that's going to be pretty bullish development. So nothing I want to really get too involved with, especially right ahead of the Fed. That's all I see on that one. So the small position I took last week, lost a little this morning, but made up for it, plus a lot more profit on the triple Q short that we took today. And, going against that, just to show you guys what I was doing here on the hourly chart. So 279.50 has been a key level I've had marked out for a while. We've had lots of reactions on that level. We kind of overshot it on Friday, so I wasn't really interested on Friday. But today it gapped down, and it was basically, it opened the day pretty much right there at that 279 area. And so when I saw it gap down, I figured, okay, we're going back below resistance and we're going to sell down. Shorted it pretty heavily on the open. Caught, pretty much all the move, the initial thrust down. Covered that short. It rallied, it then rallied back up to 279. I shorted it again and caught this little kind of drop right here. Covered it and went flat. Together, combined, was about 1.5%. So, all right, that's all I have on that one. Okay, let's look at gold. So here's gold bullion. All right, so gold. You can see on the daily chart, we still have bullish divergence right here, all right? And it's there on the PPO. We have bullish divergence on both momentum indicators. So our last divergent low, well, that was a divergent low, and this was basically a divergent low. So we've made a series of divergent lows. We're pointed down. Looks like they want to make another divergent low, but they haven't done it yet. Maybe they'll do it ahead of the Fed. But again, these are divergent lows that have a high probability of being reversed. And especially right ahead of the Fed, because gold is going to move on the Fed. This is all about interest rates, the dollar, and gold. And so, yeah, expect gold to move one way or the other. Doesn't have to rally, but it's definitely set up with a bullish technical setup. Okay, we are in a downtrend on bullion here, like that, walking down. So downtrend in gold, bullish divergence. We've got some key, it was key support. It was about 1682. And I know it's a big mess on this chart, but 1682 on the daily chart for gold bullion. I've got all these little reactions of support marked out. There's another one. Chopped through it recently, but if you can recover, if it can recover that level 1682, and it will also be taking out this downtrend line here. Look for an impulsive breakout of that. That's probably what I'd want to wait for before getting too aggressively long on gold or gold miners by proxy. But if you can rally up, and maybe it happens on the Fed or shortly thereafter, but if you can rally up, you're probably going to get at least initial reaction at that 1680. They'll probably try to reject it. But if we can recover and boom, pop it, especially it needs to be an impulsive breakout, then if you get that, that's a buy signal in my book, and a longer term buy signal as well, a trend buy signal, not just necessarily a short little swing trade, but probably something that's going to be kicking off the next longer term rally or leg higher in gold. So look for that. The other thing that you do want to take notice of is, and again, we're looking at, here's the daily chart. It shows up on the weekly very clearly, but this big pattern here, cup and handle. So it's a big long cup and handle. That's an accumulation pattern, and this took place over 7-8 years. This big long accumulation pattern. You broke out. We've been making the handle here, and we're about to the handle usually could go about to the 50% mark. So here's your cup, top of the cup here, bottom of the cup, and the middle is right about here at about 1570. So we could thrust down, hit that, but that's about where the handle will, stop selling down, and then you'll want to look for that breakout. All right. And this would signal the next long, large leg higher, which would be something like this, starting from 2001 up to about 2011. It'd be a rally potentially like that, where you're breaking out and, rallying on for the next secular leg higher, I believe is what they call it. And this was a rally of about 650% in gold. So the miners obviously went up a lot higher. So that's bigger picture stuff. Again, going back down to the hourly chart, on the hourly for gold bullion, you can see that We've got some bullish, it just shows up. It's basically the same bullish divergence, but look, there it is. That's your divergent low there. And even here, if I zoom into the very short time frame, you've got a bullish momentum here while the price is drifting lower. So that's a bullish divergence as well. Probably could mark out some sort of a bullish falling wedge pattern here on gold. It looks like we've got something going on like that. So yeah, like a bullish falling wedge, bullish divergence on the hourly. Again, it looks bullish to me. I think we're going to break out to the upside. So this is something I'll be looking to trade or add to. I have some positions in miners, looking to add to those probably after the Fed. Looking at GDX, this is your miner index. Let me go to the daily chart here. And again, it's been a while. It's been a week since I've really done a lot of work on these. But okay, look. On GDX, there's your former low right here, bullish divergence, all right? You've got momentum moving higher, and you made a new low in price. Guys, if you're interested in learning this as a skill set and you want to, really study the charts, be able to really understand all the concepts that I'm talking about, check out my stock market technical analysis course. I've made that at the request of my subscribers a couple years ago. I priced it affordable, so it's obtainable for anybody who's actually interested in learning a skill set. Check that out. Link in the description below. And then also, if you're interested in joining the private member group, in that group I point out trade ideas. They don't all work out. I can't guarantee that, but I'm giving you additional trade ideas. You got to be able to trade those on your own. But then also I give you guys additional market insights. Today I kind of told everyone I was where exactly I was shorting the triple Qs at, when I was covering my trade. I was all in there posting all that stuff. So, join up if you're interested in that. Link in the description on that one. GDX has this divergent low, and we're just kind of drifting, we're sideways maybe to higher, potential uptrend has started now. And so I suspect we're going to not go anywhere until the Fed is out of the way. Potential isometrical triangle. This could break maybe either way. Okay. But we have that bullish divergence there on the daily. So it tells me it's more likely to break to the upside, although not guaranteed. And expect volatility up into the Fed. You can't trade gold, though, and the gold miners without the dollar. So here's the dollar futures. Now, the dollar's been very strong this year, obviously. I've got this trend line. This starts back in about February, pretty much all year. But here's your uptrend. The dollar futures have been walking higher on. And that trend is still intact. So that's bottom line is the dollar uptrend is still intact. Until that breaks down, it's in an uptrend. The other thing, and look, we have another reaction right there. So the dollar hit support on its trend line, gold hit resistance and sold off. It's just kind of how that works. The dollar's coming into some resistance right up here at about 111.67. So I suspect we probably pull back to the trend line or chop sideways maybe until the Fed comes out on Wednesday. The dollar has daily negative divergence. All right, we have continued to kind of build on that divergence. So divergent high, every new high going back, for a while now, since this summer basically, has been a divergent high. So this is probably about run its course, and I think it's going to reverse and start to break down, but we need to see it, and that's it. No sell signal on the dollar until we see a break of the trend. All right, need to see that break of the trend. If we're gonna get it, it might come on the Fed on Wednesday if they do some sort of a soft pivot thing. That's what the market's been talking about. So, and if they don't do the soft pivot thing, then we'll probably crash. The market will probably crash. So, I'm kind of positioned for both right now, hedged a little bit. I've got some mining stocks I'm long on. Nothing super aggressive, but, I'm positioned for that. And then I don't have triple Q short, but I'll be looking to probably short the triple Qs if we start to see that crashing price action. Okay, so that's gold. That's gold miners and the dollar. Interest rates, this is TNX, your 10-year Treasury. So this is key. The more this moves down, the more it's possible for tech stocks especially to rally. So And you have an uptrend line. We've been walking up here, divergent high. See that negative divergence on the momentum indicators? And so that was your divergent high there. And we broke trend. All right, so this is as a sell signal. And that's it. I think we head lower in the yields, which means bonds will probably be rallying. You can see we're kind of back testing the last 2 days. So we're probably going to get a back test of the trend line. But again, I think we do that. I think we continue to trend lower. Target right now on that is about 350. And I think there's actually, if I go to the weekly chart, you'll see here, this goes back to like 1981. Here's your downward price channel in the interest rates going back 40 years or so. And you can see that we've broken out now. So this is a breakout, but maybe we come in for a back test all the way down here. Here's your 200-day moving average. Something down here at like 276 would be a buy zone. Or I mean, you can't buy the yields, but you can buy the the TLT basically would be falling there. So, as interest rates fall, all right, as this goes down, if it continues to go down, then the TLT, and I think there's another one like IEF, I believe. Is that it? Yeah, the IEF. That one will rally. Okay, so and also you look at this one. You see here bullish divergence. See it right there? And just barely there, but it is there. So the bonds are kind of set up to rally a little bit. I think rates come down, bonds rally, and gold gold should rally if that happens. So again, I'm long gold miners, some of them. I do not have a short on triple Qs because it looks like the bonds are going to rally and gold is going to rally. And that's not necessarily bearish for tech stocks, okay? Because as interest rates come down, then that usually helps the growth of tech stocks. So no shorts there on triple Qs yet, but we'll see. Okay, JP Morgan. So talking about interest rates, got me thinking about the banks. So if interest rates are going to fall, then, that's maybe going to be bearish for the banks, at least in the short term. At least that's the perceived, the perception is that higher interest rates helps the banks, lower interest rates hurts them. I don't know if that's exactly true in reality, but the perceived perception. So on JP Morgan, I was looking on the daily chart, and you can see we've had a really strong rally since earnings. They've rallied right into resistance at the 200-day moving average, but that's a 23% rally in a couple weeks. So, that move might be done. And I think we're likely going to get rejected at the 200-day right here. We're in a bear market, and when you're in a bear market, you typically get rejected at the 200-day moving average. And there we are right there. So something to look at. But I do think it's very likely or probable we pull back. We've got support here at 119. And then if we break below that, and let me get rid of this trend line because it's really not my favorite. I just have it up there. I think if we break below 119, should have right down to this 105 area as the next level of support. All right, so for me, that's the two ranges. First stop there, 109 or 119. Second stop, 105-ish, right there, 105. Looking at the hourly chart on JPM, you can see we've been building negative divergence on the hourly. All right, see that trending lower? It's very obvious on the PPO. So price has been drifting higher right here. All right, but momentum has been drifting lower. So we have negative divergence at the 200-day moving average. It's subjective, I think, to take a short position here. No guarantees it's going to work out, but definitely an objective area to short. The only caveat is we got the Fed on Wednesday. So that's the one thing that's probably going to potentially just throw this off. So, one way to do it is maybe take a starter position, keep it kind of light, take a starter position, in my opinion, and then add to it maybe after the Fed. But that's what I'd be watching. And another way to look at it, if you go to the hourly, you can see here that we've kind of got this little, they're kind of starting to break it actually when I look at that. Yeah, not really my favorite. It's just starting to break down, drift sideways. Yeah, I don't know. I don't have much of an opinion of what this is going to do, right before Wednesday when the Fed comes out. But it does look like it could be topping out. It is objective again on the daily chart to short this thing at the 200, and I suspect this thing starts to move lower. Okay, so there's a new trade idea. Trade it how you see fit, or don't trade it at all. If you don't feel comfortable with it or don't like it, then don't trade it at all. No negative divergence on the daily chart on this one. So this, for me, is probably just a pullback trade to that 119 or so, to start. And you probably get a bounce there. Netflix. So Netflix has made its way into that gap. I've talked about that as being kind of a key target there at that gap fill at 330.31. Here's the thing. I don't think we're going to fill the gap. And it could. If it does, it's going to be a quick spike up on the Fed maybe. Could spike right up, fill the gap. It's objective to short at that gap. If you get a move into that gap or close to, it's objective as a short position. And especially depending on what the charts look like. If you have negative if it's a divergent high and you're rallying right into that gap fill resistance, yeah, that's objective. The thing is, it's such an obvious gap. It's just this humongous gap. Anybody can see it. It's just right there. Oftentimes when it's so obvious, they don't actually fill the gap and don't give people an objective area to short. So yeah, if I was long, I wouldn't give this thing too much more room. Yes, it could rally up and fill the gap, but I definitely would be lightening up my position as we've already made our way, into the gap. And when it gapped up right here, it's already gone up 15-16% in a matter of about week and a half or so. And I just don't know if it's going to actually fill that gap. I don't wait for the gap fills when I am taking trades. I always step in early. So yeah, that's what I see on that one. Now looking at the hourly chart, you can see negative divergence starting to build here on the hourly. See how the momentum is just dropping off, and we're kind of grinding higher in price, but the momentum's dropping off. That's this is the late to the party people, or they're going to end up getting trapped. So from my perspective, it's definitely not safe to enter any new longs, and I definitely would be looking to lighten up if I had a position. Again, we might fill that gap. It's there's that from where we're at right now. It's a move of another 12% or so to the upside. So maybe it does that, but it just it doesn't make sense to hold out for every last penny on a full-size position when the gap's so obvious. Okay, that's all I have on net. Snow. Someone asked me about snow and how I felt about it. I think there's probably more downside. I can't say whether there's more downside, in the next few days because we're not at a key level. But you can see there's a downtrend line here, all right, on this daily chart. Walking down this downtrend line, we recently hit it, got rejected, and we're, still trending lower. But, they could always rally it up and, let me get rid of that. They could always rally it up and hit that trend line again in the next couple days or after the Fed. As long as we're below the trend or within trend, you got the 200-day moving average just above it, then we're in a downtrend, and I would assume that we're going to head lower. So I think lower, all right? Next, we don't have support until we hit about 146. You get down there, you got some support, so maybe you get a bounce there. And then we just start taking out those levels. You just head down to the next level. So down is what I would believe, and I don't see any indication in the chart telling me difference. On the hourly chart, you can see here kind of slight upward movement in momentum, slight upward movement in price, no divergence. So this is just a flag. It's a bear flag. You kind of flag down, you flag out, and then boom, break down. So I put good probability that we head down to this level here, 146, we'll call it. 146, that would kind of be the projected target of a flag, of the bear flag, as well as it's good support down there. So that's what I see on that one. That's all I got for right now. Again, I'll try to throw stuff out there in these videos leading up to the Fed, but again, there's not going to be it just all the moves that take place ahead of FOMC meeting, especially this one, is just need to be kind of, they need to be you need to take them with a grain of salt, because it's big institutions aren't going to be moving huge amounts of money ahead of the Fed. They want to hear what the Fed has to say, and then they'll act. Okay, and that's what most likely we're going to look to do as well. Guys, drop me a thumbs up if you haven't done so in a while. I do appreciate everyone that's been with me for a long time. Hopefully you guys are getting value. Thanks for letting me go out and take a vacation for a while. Helps my mind sharpen up and rest. That's important in trading, work-life balance. So thank you for sticking by me, and we'll get back into it this week. Take care. Bye.